Okay, well, it's been a while since I've talked about how I paid off my mortgage in 2 years and 9 months. But as you can see here in July 29, 2024, I did pay it off, lien position one, and then I got the loan in 2021, so just subtract 30 here. And so I'll give you my perspective, and let me repeat myself, as a person who paid off a mortgage in 2 years and 9 months. And there's a lot of people on the internet who talk about this, and I think they're just talking out of like whiteboard theory and not just kind of using Excel because Excel is pretty spot on, right? So, one of the things that you're going to hear is that, paying off your mortgage is really, really hard or something like that, right? Or they make it seem like it's really hard. And really, the hardest part about paying off debt is not just paying one or two loans, right? Like if you're in a position where you only have like the mortgage left or an auto loan, you're probably better off than most people. And I would say, hey, if you can just make extra payments and get rid of it quickly, then do it. The reason why most people can't do that is because there's a very psychological component about money that I think the only person I really heard talk about this is Dave Ramsey, which is why he promotes like the snowball method, right? He's like, yeah, avalanche is highest interest, but trust me, like you do the snowball, you pay it off, and you'll gain the momentum to pay off the debt. Okay. So if you have one debt, that's fine. And one of the things that you always have to understand is that life is about trade-offs, right? So if something is a little bit more expensive, and we always have to make these decisions when it comes to things that cost more versus the cheapest item, um, is it worth it to pay a little bit more, right? I don't know if you ever heard the term that cheap is actually more expensive because it breaks down more. We have to think about that in our strategies as well, right? And if you end up paying a little bit more for something you're much more likely to do rather than the perfect ideal scenario that you're never going to do, I would rather have you pay a little bit more for the probability that you're going to achieve your goals, right? And the reason I'm talking about this is because a lot of times when people talk about paying off your mortgage, there's a very dogmatic, like, oh, line of credit is always better than a loan. Line of credit is always better than loan. And my counter response to that is, what about a 0% loan? Like, if you use an 8% line of credit to pay a 0% loan, even using that line of credit, let's say for one day, you're going to end up paying more interest than if you just made the minimum payments for 30 years, right? Because it's literally a 0% loan. Now, why might I use a 8% line of credit to pay a 0% loan? And one of the things that you'll realize when you deal with interest rates of loans and lines of credit is that loans will pretty much always be cheaper um, than a line of credit given the same borrower profile, right? Because the interest rate represents two things. Number one, it represents the risk level of the person borrowing. So if someone's really risky, aka subprime borrower, that they're going to have to charge higher interest rates. And then the second thing it represents is access to your money. So one of the reasons why loans are always cheaper is because it's hard to access that money. If I overpay a loan, I can't get, actually, this is more perceived than anything. I can't really get it back. Whereas with the line of credit, if I overpay the line of credit, I can easily get the money back. Okay. And so we have to think of terms of trade-offs, and if it makes sense just to pay a little bit more in the worst case scenario. Okay, that's really how I'm thinking about it. So here, let's say we have a 0% loan. Okay, a 0% loan, and I decide I'm going to be the dumbest person on earth, right? And hey, I'm going to use this thing called velocity whatever, which we can't use velocity banking anymore because of the state of Illinois. But yeah, the velocity method, right? And so let's say I do this thing called chunking, which is just moving a piece of loan into the line of credit. And I end up, because this is a 0% loan, remember, worst case scenario, end up paying $1,800 more for using that method. And it gets paid off in like 5.3 years, right? And if you distribute, let's say this divided by 5.3, how much is that? So let's say, yeah, that's about $400 a year, right? So some Amex credit cards even cost that much, okay? about $400 a year, probably a little bit less. But my point is this, right? $400 a year to use a tool that will help you manage and centralize your money to help pay off your debt might be worth it. I'm not saying it's 100%, but it might be. Or you could just make extra payments and for sure you'll save $1,800. And so a lot of times, people say like, "Oh, line of credit always better than loan." I don't know. Do you want to save $1,800 over 5.3 years if you're going to use this method? Maybe. But here's the thing, right? It, here's we have to kind of think about, is the juice worth the squeeze? So if I move this loan into a line of credit, aka first lien HELOC, I end up paying 76 grand, and I don't think there's a real justification for paying 76 times more than you have to, right? So if you pay maybe 1 grand, 2 grand more, okay, well, yeah, I shouldn't, I don't really want to pay that, but if it's going to actually help me do it, then possibly, right? And so one of the funny things that a lot of people don't know is that let's say I do the line of credit chunk and then I do like 15%, so I almost double the interest rate. This turns to 3,500. So that 250 at 8% will actually be worse off like than 6% at 15, or 6,000 at 15 and 6,000 at even 30%, right? Whoopsie, I put 304. Hold on, let me do this. 30. And so you see that even a 30%, let's say credit card or whatever that you're using to pay the mortgage, if you're actually going to use a 30% credit card, which I don't know why you do that, but let's say you do, okay? 30% credit card is actually going to be cheaper than a 15, I'm sorry, an 8% first home equity or first lien home equity line of credit, okay? So we have to really think about this. You can't just say, hey, a line of credit is always better than a loan. There are trade offs in everything, right? Life is about trade offs. Now, if you talk to most politicians, they say they can get you something and it's free and, nothing bad will happen. And we know how that works out. Okay. So let me go back here and I'm just going to show you why, me personally, I actually liked using the chunking method. Okay. And there's a very huge psychological component of doing the chunking method that I didn't see with doing extra payments. In fact, extra payments was way harder for me because extra payments was actually decision fatigue. Decision fatigue. So when someone says like, "Hey, you can do extra payments," I actually agree with them if you're actually able to do it, but I couldn't do it because there was decision fatigue because pretty much every month you have to decide how much you have to pay extra to the loan. Okay? And that's not going to be the same month to month, right? Because expenses will vary from month to month, whether it's a couple hundred. So it's not going to be the same. Whereas with using the HELOC method, since you're using your HELOC as a sweep account, your goal is the same every single day, which is to put the checking account balance to zero and move everything to a line of credit. So between these two methods, I actually have to think here, which leads to decision fatigue, which means I'm not going to do it. And I talk about this all the time where I don't like plans or advisors who tell me that I have to think about stuff. I like plans where I don't have to think, where I could just do the same thing over and over again and it doesn't require my creativity. Okay? So this is why this chunking method where you could call it incremental payoff where you're moving a piece of the loan into a line of credit is actually really powerful because your mind almost inverts how it perceives the transaction. Okay, so I put perceived risk level right here. Okay, and so the way that people perceive sending extra payments to a loan is that the money is gone forever final. And that's not technically true, right? Because if you have lines of credit as backup, you could get the money from the line of credit. But what I'm saying is this: when you make extra payments into a loan is a one-way street. And so people have an inversion or aversion to making that extra payment because the negotiation cycle goes on of should I pay extra today, which eventually leads to decision fatigue, which means that you're going to go back to the default of only making the monthly payment, right? And then here, the perceived risk level is lower, okay? Because it just seems like this is reversible. And so if you've ever seen me do the demonstration with the HELOC, right? It's just kind of like this, where hey, let's move $10,000 from the loan to the line of credit, and then look, in 2 months it got paid down, right? So do this, copy paste, right? And then we just do it in 2 more months, it gets paid down, and it kind of rinse and repeat over and over again. And the reason why this is actually psychologically easier, because when you're making extra payments, the only thing you see is the $300,000 going to, let's say, 295, and in your brain the 295 and $300,000 look exactly the same, and so you are draining your energy when you see that, and that's why it feels like hard work, right? So that's why it's easy to skip a month when you're tired. It's easy, right? Because now you have to think too much. Whereas here, because you're staring at that $10,000 chunk of the line of credit and you see that 10,000 go down, you feel the momentum. And I felt that too. I'm like, whoa, like I paid off $50,000 of my mortgage in my first year, and then you feel the momentum. Okay. And it becomes hard to quit because the goal is actually visible. And a lot of people discount this, how money is very psychological. I mean, think about this. Your money is really just numbers on a bank server. Yet, when that number goes to zero or negative, why is it that you can't sleep? Because there's a very psychological component of money that is tied to society and our well-being, right? And so if you ignore the psychological part and human behavior, right, then you're going to go into things where you don't really perceive how hard it will actually be. Okay. And so, one thing that I have here is the lack of a dopamine bridge. So, willpower is generally fueled by results. Okay. So, if you send 500, like I said before, if you send $500 to a $300,000 mortgage as an extra payment, you only go down from 300,000 to 299,000. And so it looks the same, but there's no win signal to the brain. And without that hit of dopamine, your willpower has no fuel to recharge for the next month, right? So that's kind of like the main difference to me, is that yes, let's say the loan is much cheaper than the line of credit. 0% loan, 8% line of credit, right? And in real life, it's going to be 3 to 6, 7, whatever. But worst case scenario, 0% loan. Okay, well, the HELOC might be cheaper, but what advantages would the HELOC represent if I were still to use that tool, and why would I still use that over, let's say, an extra payment, right? So that's really all it is. And also, don't use a first lien HELOC, right? So, yeah. So this is just, you'll understand this if you've ever done it yourself. And the most important thing about paying off debt, and when it comes to your mortgage, is that you essentially have to pay it off last, because the cash flow index, if you don't know how that system works, basically that if in order to get rid of my mortgage, 300,000, I only get itty bitty amount of cash flow. Okay, you only get itty bitty amount of cash flow, and that's why you have to pay it off last. So whether you're doing whether you're using the HELOC chunking strategy or extra payments, doesn't matter as long as you pay it off last, right? Debt payoff order is way more important than whatever, using the HELOC versus extra payments. I don't think people emphasize that enough. Okay. All right. Well, that's it for today, folks. This is Freelance Mentorship here with another video. Have a great day, and I'll see you on the next video.